Joining us at Post 9, Fundstrat Global Advisors co-founder and head of research, Tom Lee. Welcome.
Happy New Year, everybody.
So everybody was negative this time last year, but you were not. Why?
Yes. Well, it's really two things. One, we thought inflation would fall like a rock, whereas many were bracing for a decade of sticky Fed fighting inflation. And the second was, if that was true, that we would avoid a hard landing, and soft landing was the most probable outcome. So that's pretty stock friendly, right? Inflation falls like a rock, you avoid a hard landing, and markets were down 20% the year before.
So in 2024, will inflation keep falling like a rock, and will we still have a soft landing?
Yeah, I think your food chart is spot on. I think consumers will realize that the rate of price increases is slowing. We saw it in the UMich surveys. That will give Fed a lot of leeway to cut rates next year to keep real rates constant. Housing and autos is really 70% of inflation, so both are going to normalize, and that means 2% is going to be very visible next year. And I think it's a huge relief for equity markets when that happens.
Tom, Happy New Year. First
New
off, congratulations on your calls this year. You've been directionally correct. That's hard to do, so kudos to you. You're top dog now, 5,200. You have the high estimate for the S&P 500 for 2024. Johnson Stoltzfus, we just had him on. He also had 5,200. You're top one. I wonder if you can explain what goes into making that up. It's always a little bit of a mystery to us what you macro guys do. You know, an analyst who covers Caterpillar, he studies Caterpillar, earnings estimates and makes a projection, but you have to do this estimate from the top down. So what goes into this? Do you guys get together in a retreat on the weekends and, drink a lot and figure out what's going to, come up with a number? How do you come up with this 5,200?
Yeah, it's really sort of three parts. The first part is, what is probable based on sort of market history, like where we are in the business cycle, what did the markets do the year before, where's positioning. That's more of gives you a pretty wide highway to think about what markets could do. So next year, double digits is more than a 50% probability, even though we were up 25% this year. But then we look at E, the earnings, and we think, can you grow 10%, which I think is easy base case because there's pent-up demand for CapEx, and we know the PMIs are going to turn. And the guidance actually has been pretty decent. And then it's what multiple do you apply? This is where I think people make mistakes. When the 10-year is at between 3 and 4%, 65% of the time the PE is over 18 times. 50% of the time it's over 20. That's since 1900. Well, the S&P equal weight is 15 times forward, or ex-FANG, it's 15 times forward. Well, if that 15 goes to 18 or 15 goes to 20, the stock market's going to be up 30%. So we figure, well, you hold the multiple, earnings grow 10, you get 5,200, but that means there's upside to that number.